What's up, everyone? Welcome to Understanding Futures Trading. In this video, we're going to break down the basics of futures trading, the strategy behind it, and how technical analysis plays a huge role in making informed decisions. No complicated jargon, just a simple explanation of the essentials you need to get started. Alright, let's start with the basics. What exactly is futures trading? Picture this, you're trading contracts to buy or sell something like oil, gold, or even a stock index, but not today. You're agreeing to make that trade at a specific time in the future. That's the core idea behind futures contracts. They're agreements to buy or sell an asset at a set price on a future date. Now, the key part here is that you don't have to hold on to the contract until that date. Most traders, especially short-term traders, don't let the contract expire. Instead, they trade it before the expiration, using strategies to predict where prices will move. So, why would anyone trade futures? The short answer is strategy. Futures trading allows people to hedge against risks or to profit from price movements by using technical analysis. Hedging. If you're a business owner and you're worried about the price of oil going up, you can use futures to lock in a price today, which protects you from those price swings. It's a way to minimize potential losses in the future. Speculation with strategy speculators, on the other hand, are using futures to make money by predicting price movements. But here's the thing, they're not just guessing. They use tools like technical analysis and chart patterns to analyze past price data and predict where the market is heading. Now let's dive into the heart of futures trading, technical analysis. If you're going to succeed in futures, you need to understand how to read charts and recognize patterns that tell you where prices are likely to go. Technical analysis is the study of past market data, mainly price and volume, to forecast future price movements. Traders use charts to spot trends, key support and resistance levels, and patterns like head and shoulders, candlestick formations, and more. For example, if you notice that an asset's price is consistently bouncing off a certain level, that could be a sign of strong support. If the price breaks through that level, it could signal a trend, reversal, or continuation. Before we go further, let's go over some key terms you'll need to know. Contract size. This refers to how much of the asset you're trading. For example, one contract for crude oil might represent 1,000 barrels. So when you trade, you're trading a set amount of the asset. Expiration date. This is when your contract expires. But remember, most traders close their positions before the expiration date, so you don't always need to wait. Leverage. Futures allow you to control a large position with a smaller amount of capital. This can lead to bigger profits, but it also means bigger risks, which is why managing your trades is crucial. So, how do you actually trade futures? The first step is understanding that futures trading is not a game of chance. It's about strategy. Successful traders use multiple strategies based on their analysis of the market. Here are a few key strategies you might use. Trend following. This is when you identify a trend in the market, whether it's up or down, and trade in the direction of that trend. The goal here is to ride the wave as long as the trend continues. Range trading. This is when the market is moving within a set range, and traders buy at the support level, the lower end, and sell at the resistance level, the upper end. You're playing within the boundaries of the market rather than betting on a breakout trading. When the market breaks above a resistance level or below a support level, it could signal the start of a new trend. Breakout traders are looking to jump in when this happens and take advantage of the price movement. Scalping. This is a short-term strategy where you make lots of small trades throughout the day, aiming to profit from tiny price changes. It requires a lot of attention and quick decision-making. Now let's talk about how futures trading works. Futures contracts are traded on exchanges like the Chicago Mercantile Exchange, where buyers and sellers meet to trade these contracts. When you place a trade, you're entering into an agreement to buy or sell a specific asset at a future date. You don't need to hold the contract until the expiration date. You can sell it before then if you want to lock in profits or cut losses. You'll need a broker to get access to these markets, and your broker will require a margin deposit. This is your collateral that gives you the ability to trade larger positions with less capital up front. But remember, just because you can control a larger position doesn't mean you should. Speaking of margin, let's talk about risk management. Futures trading can be rewarding, but it's important to know the risks involved. If the market moves against you, you could lose more than your initial investment. That's why managing your risk is so important. Here are a few strategies to protect yourself. Stop-loss orders. These are automatic orders that close your position if the price hits a certain level, preventing you from losing more than you're willing to risk. Position sizing. Only risk a small percentage of your trading account on each trade. This way, even if you hit a loss, it won't wipe you out. Diversification. Don't put all your eggs in one basket. Diversify your trades to reduce risk across different markets or assets. Alright, so you're probably wondering, how do you actually get started? Here's a step-by-step breakdown one. Pick a broker. Find a reputable futures broker that offers access to the contracts you want to trade. Many brokers offer demo accounts, so you can practice risk-free. 1. Learn the tools. Get familiar with trading platforms and charting tools. Spend time learning how to read charts and identify key levels, patterns, and trends. 1. Start small. Start with a small account and trade with real money only when you're comfortable. Practice risk management and be patient. This is a marathon, not a sprint. And that's a wrap on Futures Trading 101. The key to success is having a solid strategy and understanding how to manage your risk. With practice and dedication, you'll be able to use technical analysis and proven strategies to make smarter decisions in the market. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you won't miss our next deep dive into advanced futures trading strategies. Thanks for watching, and we'll see you in the next one.